That was great.
Hey, everybody. Welcome to the latest edition of Labor Market Watch. I'm Peter Carr, Vice President of Client Services here at Shaker, and fresh off my annual family summer vacation to my in-laws' cabin in Montana. Of course, it's great to be back. Come on, people. Who would rather be traversing the great outdoors, pulling rainbows and brownies out of the Gallatin and Madison rivers when they could be sitting right here behind this comfy desk, bringing you a Q2 wrap-up of the U.S. labor market? So let's get to it. We begin as we do with looking at average monthly job gains for the year. Compared to 2025, the first 6 months of 2026 does look better. Last year, average monthly job growth basically crawled in at about 15,000 jobs a month. This year, through Q2, we averaged around 75,000 jobs added per month. So technically, yes, things seemingly look better. But here's the problem. The trend is softening, especially with the negative revisions we keep seeing each month. It seems crazy, but the U.S. jobs numbers have now been revised lower in 21 out of the last 30 months to the tune of 1 million jobs less than what was initially reported. So the story here is hiring has rebounded from 2025 stall, but Q2 showed clear signs that momentum is fading. For employers, that means the labor market has not yet collapsed, but it's trending in the wrong direction for sure. In terms of monthly jobs reports, the first half of the year has been a real roller coaster ride, with Q1 being the hills and drops part of the ride and Q2 being the straight down spiral part. For Q2, April jobs came in fairly strong at 148,000 jobs added. May dropped to 63,000 jobs added after initially being reported at 172,000 jobs added. And June came in at just 20,000 jobs added after initially being reported at 57,000 jobs added. That's right. Just with the July report, we saw revisions that wiped out over 100,000 job gains in Q2. And that's the reality of jobs data revisions. The first number comes out and everyone reacts. Then in the following months, the government comes back and says, yeah, not so much. So Q2 showed a steady downward trend in job gains. At the same time, unemployment stayed relatively stable, averaging around 4.3% before dropping to 4.2% in June. And that's where workforce planning gets tricky, because if you're an employer, you haven't really been looking at screaming recession signals. You've been looking at a labor market that keeps saying, I'm fine, in the exact same tone people use when they're absolutely not fine. And you can definitely see that in the labor force participation rate. This is where the labor market starts doing that thing where the headline doesn't look terrible, but if you dig into the details, it starts telling a more ominous story. Yes, the unemployment rate fell to 4.2% in June, but labor force participation also fell, dropping to 61.5% by the end of Q2. And that matters because unemployment can fall for two very different reasons. Reason number one, more people found jobs. That's great. Reason number two, fewer people are looking for jobs, and that is less great. That's like bragging your restaurant wait time went down because half of your customers left. Even prime age participation, those workers that are aged 25 to 54, sank from a 25-year high of 84% in January to 83.3% by the end of Q2. That's still historically strong, but the direction we've been going in matters. So the takeaway is this: even in a slower hiring market, talent supply is not suddenly easy. If fewer people are participating, replacing workers is still hard, still expensive, and still annoying, which is why retention continues to matter, because it's not great realizing your best replacement candidate is already employed, not looking, and ignoring your recruiter's outreach. So where were the jobs actually added in Q2? Once again, education and healthcare did what they always do. Even with the revisions we saw last week, they carried the economy, seeing gains of 145,000 jobs in Q2. Professional and business services added 60,000 jobs. Transportation and warehousing added 29,000. Retail added 25,000. Then some anemic growth across other sectors. On the other side, leisure and hospitality, government, information, and financial activities all lost jobs on the whole in Q2, with information and financial activities showing the largest losses, but both of these sectors saw double those losses in Q1. So there has been some curbing of losses in those industries in Q2. The big takeaway, industry demand remains uneven. Healthcare continues to lead. Professional services are still adding. Transportation is showing strength, but white-collar and consumer-facing sectors are more mixed. Now, let's talk about everyone's favorite topic, the growing cost of simply existing. In Q2, wage growth averaged about 3.5%. Inflation, though, averaged about 3.8%, which means workers technically made more money, but consumer prices grew at a faster pace than those higher earnings. That is not wage growth. That's the economy handing you a raise and then immediately following you to the gas pump in the grocery store to take it right back out of your pocket. In April and May, inflation outpaced wage growth. In June, wage growth matched inflation. So the good news for Q2 was, by the end of Q2, workers stopped falling behind. The bad news is, July's inflation reading came in at just 3.5% against July's wage growth reading of 3.2%. That came in last week. 3.2% wage growth was the lowest reading in 5 years. So inflation rate continued to be higher than wage growth at the beginning of Q3. So on the wage front, for employers, this matters because compensation pressure does not disappear just because hiring slows. Workers may not be demanding 2022 level raises anymore, but they are absolutely living in 2026 level prices, and they are paying attention, pun intended. Moving on to job openings, JOLTS report gave us insight into the full Q2 reading of available jobs in the market. It showed the number of job openings popped in April to 7.58 million after sitting at 6.89 million in March, then settled back to 7.36 million by the end of Q2. So openings jumped, then tapered off, but these last three readings for Q3 are at 1.5-year highs. The key number here is that we're hovering at roughly one job opening for every unemployed person. That means the labor market is much more balanced than it was a few years ago, but it is still very competitive. Quits have remained relatively steady over the past few years, but rose a bit through Q2. In April, we saw roughly 3 million quits. In May, a little over 3.1 million quits. And in June, just over 3.2 million quits. So while workers were quitting a little more than they were in Q1, they weren't at the wild levels we saw during the Great Resignation a few years back. And they were quitting even a little less this year than in Q2 of last year. So it's not a take this job and shove it kind of mood. It's more like I've updated my resume and LinkedIn profile just in case kind of mood. And as you probably know, lower quits have been helpful for retention, but rising quits signal that workers still have options, especially in roles in industries where demand remains strong. So for employers, this is not the moment to get complacent. Yes, People may be staying put more than they used to, but staying put is not the same as being engaged. Sometimes it just means the job market looks weird, rent is expensive, and nobody wants to gamble on a new manager. The devil you know is better than the devil you don't. Now, let's talk about layoffs and discharges. There's been a lot of headlines about layoffs, but the actual numbers aren't signaling major alarms, at least not just yet. The broader numbers are basically at historical pre-pandemic norms. In April, we saw 1.67 million layoffs and discharges, and it was flat at roughly 1.76 million for both May and June. So layoffs moved up slightly through the quarter, but they remain relatively contained. And this is one of the biggest reasons the labor market still does not look like it's breaking. Hiring is slower, quits are still muted, openings are a little more balanced, but employers are not broadly cutting workers at recession-like levels. This is what we called in Q1 a low hire, low fire market, and that still applied in Q2. So for workforce planning, that means available talent may still be limited. Slower hiring does not automatically create a deep candidate pool, especially when the participation rate is shrinking and layoffs remain contained. And speaking of layoffs, Challenger, Gray, and Christmas reported that through Q2 2026, US-based employers announced just under 444,000 cuts year to date. That's down 40% from the 744,000 cuts announced during the same time period last year. So on the surface, great news, fewer layoff announcements. But when we look at the industry detail, it gets a little more complicated. Technology announcements are up, transportation announcements are up, healthcare announcements are just slightly up, services announcements are down, and government announcements are way down compared to last year. AI is the number one reason cited for all announced cuts so far this year. That's 100,000 cuts attributed to AI, or roughly 25% of the total number. On the flip side of layoffs, Challenger also said that companies have announced plans to hire over 107,000 workers. That's up 25% from the 86,000 announced during the same time period last year. And it's the strongest year-to-date total since 2023. So good news there. But the reality is employers are still being cautious. They're not announcing layoffs at last year's pace, but cuts are still happening. And they're increasingly tied to restructuring, automation, and productivity pressure. And they're still signaling at hiring more than they were last year. But we'll just have to wait and see if that actually pans out as future jobs reports are released. So what's the big takeaway from Q2? The labor market is still standing, but it's definitely leaning on a cane. Hiring has improved from 2025, but it's softened throughout the second quarter. Job growth slowed month by month, participation fell, wage growth struggled to keep up with inflation, openings are up. Quits ticked up, layoffs remained manageable, and employers are still operating cautiously. So for employers, the message is, please don't confuse a cooler labor market with an easy labor market. The best workers still have options, replacement is still expensive, compensation still matters, candidate supply is uneven, and workforce planning needs to be more precise than ever. But as we look ahead into the second half of 2026, July jobs report may end up being the most important labor market data release of the year. Not because payrolls fell by 23,000 jobs, and not because unemployment dipped to 4.1%, but because it may have answered the question, is the labor market cooling because employers need fewer workers, or because fewer workers are available and looking for work? Right now, the answer appears to be both. The July report continued many of the Q2 trends I just outlined. Job growth weakened, wage growth slipped into its lowest level since 2021. Labor force participation fell again in July. And the unemployment rate improved, but largely because fewer people were actively participating in the labor market. That's why I think the biggest labor market story for the remainder of 2026 won't be layoffs. It will be labor supply. The pool of available labor appears to be shrinking at the same time economic growth is slowing. So the challenge for employers is changing. This isn't the hyperactive labor market of 2021. It's not the stall we experienced in 2025. It's a labor market that's becoming more selective, more demographic driven, and more dependent on retention, productivity, internal mobility, and workforce planning. The labor market isn't waving a red flag yet, but it is waving a yellow one. And if you've ever watched a NASCAR or Indy race, you know the yellow flag isn't the time to stop paying attention. It's the time to get ready for whatever comes next. Thanks, everybody. That's it for this edition of Labor Market Watch. The economy will continue to be unpredictable. The government will continue to revise the numbers, and I'll continue pretending that a decimal point in the labor force participation number didn't just ruin my week. Labor on, y'all. See you next quarter.